Systemic break of 2026, the end of the dollar and Bitcoin. Introduction. Since 2008, we have repeatedly been told that the system is stronger, better regulated, more resilient, that lessons have been learned, that the next crisis will be under control. But what Gilles Bonaffi is going to show you today, supported by indisputable official figures, is that we have entered a zone where the system can no longer be saved as before, not because of a single shock, but because 12 major systemic fractures are converging simultaneously in the United States. This is not a prophecy, it is mapping of reality. You do not need to be an economist or an expert. Everything will be explained in a simple, accessible way and explored further on Gilles Bonaffi's blog. This analysis is an extension of the chapter dedicated to the United States from the book The End of Economic Science, The Beginning of the Golden Age, published in French, Spanish, and English, which you can order in any bookstore or online. Fracture number one, the refinancing wall, CRE. Everything begins with a wall, a refinancing wall, CRE, commercial real estate, refers to commercial property, offices, shopping centers, hotels, logistic warehouses. It is one of the pillars of the American financial system. It currently shows a default rate of 8.78% according to CREDIQ, whose data is regularly cited on the front pages of the Wall Street Journal and Bloomberg. Even more concerning, $936 billion in CRE debt matures in 2026. For years, the strategy was simple: extend and pretend. Loans were extended in the hope of normalization. But today, interest rates have quadrupled. Refinancing costs more than these assets generate. The problem is not the face value of the buildings. The problem is that financing no longer exists. Fracture number two, multifamily, default security. Multifamily refers to loans tied to residential rental buildings, often owned by institutional funds. These loans are securitized into CMBS, commercial mortgage backed securities, financial products backed by commercial real estate loans. Today, the multifamily CMBS delinquency rate exceeds 6.6%, and the share of these loans considered distressed, late payments, default, or high risk of default stands at 11.6%, according to CREDIQ. And when multifamily collapses, contagion spreads to traditional residential housing. Foreclosures have already increased by more than 40% year over year in residential real estate by the end of Q1 or quarter one of 2025, according to the OCC, U.S. Treasury Agency. Fracture number three, the equity gap, the point of no return. Let us now discuss the equity gap. The equity gap is the difference between the real value of an asset and the associated debt. Today, office CBD valuations have fallen by 43.9% over the last 3 years, according to MSCI and CoStar. Office CBD refers to office buildings located in central business districts, the economic cores of major metropolitan areas. Around 300 billion in office debt, including CBD, matures by the end of 2026, creating a massive equity gap. Roughly 100 $220 billion in asset value will disappear in 2026. Fracture number four, shadow banking, the unsalvageable zone. Nearly 60% of U.S. commercial real estate is no longer financed by traditional banks. It is financed through shadow banking, private funds, opaque vehicles, non bank structures. This is not mysterious finance, it is finance that escapes oversight. Globally, this represents about $256 trillion. dollars. These entities can neither be regulated like banks nor rescued by the Federal Reserve. When things break here, no one can intervene. Fracture number five, cascading credit defaults. Subprime auto loans are reaching record default levels. ARM, adjustable rate mortgages, are resetting, and ARM is a variable rate mortgage. When rates rise, monthly payments automatically increase. For 2019 ARM loans, this means more than $400 per month in 2026, more than $200 for 2020 loans, the 2 years that concentrated the highest volume of these loans, a catastrophic multiplier effect. Credit cards and BNPL. Total credit card debt reached $1.23 trillion dollars in quarter three of 2025, a record. Credit card defaults are rising and approach 4%, representing roughly $50 billion in losses. BNPL, buy now, pay later, is under pressure. It is disguised credit use when income is no longer sufficient. Consumers are already maxed out. They will not absorb the shock. BNPL will represent about $50 billion in 2026, days delinquent. According to Congress, defaults in 2026 will not be $117 billion, but $234 billion, double, assuming everything goes well. Fracture number six, the derivative time bomb. For $231 trillion in derivative in the US, banks currently report only $252 billion in potential losses. This is known as NCCE, net current credit exposure, the immediate net bill a bank must pay if all its counterparties fail. Contract volume have increased by 37% since 2008, while NCCE has been cut in half, declining from a ratio of 0.22% to about 0.11%. Even though a Harvard study explains that the real NCCE ratio should be twice as high. Therefore, today's NCCA ratio should actually be multiplied by 4 to cover immediate losses. In 2026, under the same shock, the bill will not be $250 billion, but more than $1 trillion. But there is worse. The IMF identified a shortage of real collateral equivalent to $2 trillion in impact for 2008, NCCE by 5. In summary, real NCCE should not be multiplied by 4 but by 20, meaning $250 billion by 20 equal $5 trillion that US finance will have to absorb in 2026 in the event of a systemic crisis. Concentrated at 86.3% within four US banks: JP Morgan, Goldman Sachs, Citibank National, and Bank of America. The impact will be colossal and will have to be absorbed by the Fed. The classic privatization of profits and socialization of losses. This will freeze credit in the United States. NCCE, the real direct and indirect exposure, should therefore stand at 2.2%, not 0.11%, thus multiply by 20, something that Bonafi explained for years. For researchers seeking the real impact of OTC derivative, here is the exact figure. Modern finance has made the apocalypse invisible through semantics and mathematical complexity, with a factor of 20 between reported exposure and reality. The myth of financial regulation is destroyed. Fracture number 7: hidden unemployment and precarity. Let us now look at the real economy. 1.9 million people left the labor market in 2025. The participation rate fell back to 62.1% in December 2025, meaning that 37.9% of working age individuals have disappeared from unemployment statistics in the US. SNAP, U.S. Food Assistance, gained more than 700,000 beneficiaries in 2025. Official unemployment lies by omission. Precarity never lies. Fracture number 8: the repo market, the final freeze. The repo market is the bloodstream of finance. It allows securities to be exchanged for short term liquidity. The Office of Financial Research of OFR estimated the U.S. repo market at about $12.6 trillion per day in quarter 3, Q3 2025. Today, haircuts, valuation discounts, less is lent, have doubled since 2022 on CMBS and CLO securities, and contagion is spreading to traditional credit. This means the same collateral now generates less cash, minus 10% to minus 20%. We could see at least a 10 to 15% impact, the 2008 scenario, on repo, a potential $1.26 trillion per day funding hold at 10%. When repo freezes, liquidity disappears and the financial system freezes. Fracture number 9: algorithmic acceleration and AI. This crisis will not resemble 2008. It will move much faster. Today, trading algorithms operate at microsecond latencies, millions of times faster than human reactions, fundamentally changing market dynamics. Numerous studies converge in showing that high frequency trading, HFT, combined with AI, creates an environment where crises can spread more quickly and with greater magnitude. The official Monetary and Financial Institutions Forum, OMFIF, and an international think tank specializing in monetary policy and financial stability, call this algorithmic herding. Institutions document a phenomenon where AI systems trained on similar data and using comparable risk models react simultaneously to the same signals. The result is a shift in the timescale of crisis. Whereas financial crises used to develop over months, then over days or hours in 2008, they can now spread in seconds or even milliseconds. In addition, markets are now driven by VAR, value at risk algorithm. VAR is a mathematical model defining the maximum acceptable loss. Once this threshold is breached, algorithms sell automatically, without reflection, without human judgment. It is autopilot, with no one in the cockpit. Fracture number 10: crypto, the last resort liquidity. In times of crisis, you do not sell what you want, you sell what you can, what is liquid. Bitcoin is therefore used as a liquidity proxy. Stable coins such as Tether are subjected to extreme stress during crisis. DEFI will implode in cascade. This is not ideological, it is mechanical. Bitcoin will survive but will lose its status as digital gold. Bonaffi dedicates an entire chapter in his book to explain this. Fracture number 11, the Fed's trap. The Federal Reserve is trapped. Its balance sheet exceeds $6.6 trillion, dollars, representing 24% of US GDP. In 2008, this figure was 6%. Even worse, nearly $9 trillion must be refinanced in 2026. With $9 trillion of US debt hitting the market during a financial crisis, all ingredients are present for failed auctions. Two scenarios therefore emerge. Scenario number one, a new quantitative easing, massive liquidity injections with uncontrolled inflation. Scenario number two, inaction, leading to systemic collapse. And above all, the Fed cannot rescue shadow banking. Fracture number 12, the BRICS system. While the West manages the emergency, another system is ready. The BRICS, BRICS, have developed a sovereign infrastructure, BRICS Pay, with the unit backed by gold, silver, and national currencies. The BRICS already represent more than 36% of global GDP. Bonaffi explains everything on his blog, deliberately renaming BRICS Pay as the BRICS Settlement Network, the draft of our future ASO, Axis Settlement Orbis, and ASI, Axis Stability Interface, which Bonaffi will develop soon. The BSN system is not perfect, but making it fully operational at the right moment will be a fatal blow to the dollar. China has already prepared by banning high frequency trading on its stock exchanges in January 2026, achieving two goals at once: protecting its markets from the coming shock and protecting the BRICS pay system. Trump's strategy, aware of the catastrophic U.S. financial situation, is to prepare the implosion and end of the American empire. His strategy is relentless: invasion of Venezuela, annexation of Greenland, Mexico, and Canada. This will mark the end of NATO, and Europe will finally realize it is merely a conglomerate of decreasing standards without strength or soul. Trump is not the person you're being sold. He is the liquidator of the US empire. This is the true meaning of America First. 2008 2026 table, the fundamental difference. Everything becomes clear. 1. The core of the system is no longer banking, therefore, not salvageable by traditional tools. 2. Speed has become algorithmic, therefore, beyond human control. 3. The Fed is already in extreme mode. Its balance sheet equals 24% of GDP versus 6% in 2008, a point of no return. 4. The social fabric is already fractured. The crisis is not coming, it is already here. 5. The world is no longer monetarily unipolar and therefore no longer has a global stabilizer. Ultimately, more than $18 trillion will have to be injected into US finance to prevent implosion. In 2026, the convergence of the 12 systemic crises will transform into a systemic break. Epilogue beyond the monetary. But let us step back. Let us move beyond pure financial analysis. What just have been described, the collapse of the dollar, the fall of the Bitcoin, the monetary war, is only the surface, the symptom of a much deeper crisis. It is not only the economy that is collapsing, It is the claim that it can be scientifically mastered. René Guénon called this the solidification of the wall, the process by which humanity distances itself from any spiritual dimension and freezes into a purely material reality, closed in on itself, deprived of transcendence, the reign of quantity, the empire's measurement without quality. And in this solidified world, money have become the new God. It grants social identity. It defines success and failure. It structures relationships. It determines what has value. But this crisis is not an end. It is the beginning of another wall, the return of quality, symbolism, and meaning. A wall finally uniting science and spirituality, sacred geometry and economics, Sophie. All of this is explained in depth in Bonafi's book, The End of Economic Science, The Beginning of the Golden Age. And above all, there is hope for a world that must be rebuilt on new foundations, which Bonafi will soon establish by developing a new sovereign, solidarity based, and fair international monetary system. I repeat, sovereign, solidarity, and fair, based on sacred geometry and circular economics, the Axis settlement orbis, and the Axis stability interface. The soul, which Bonafi will define soon, will be the settlement unit of the ASO ASI network.